Welcome back. Now let us continue the main part of our lesson. We'll start by looking into the success and failure factors relating to management, tax implication, capital, and division of profit, together with legislation for sole traders, partnerships, and all the other forms of ownership. Let us start with the sole trader. The first now criteria is your management. What is the success of a sole trader there? A sole trader as a business owned by one person, this allows for the business, or this form of ownership would allow for the owner to make quick decisions without having to consult others. However, the failure is the idea that owners have to rely on their own decision making and could make incorrect ones. So they can make incorrect decisions. When it comes to taxation, the owner is only taxed on profits in their personal capacity. So owner only taxed on profit in personal capacity, meaning in their personal capacity. The business is not taxed, but the owner is the one who's going to pay tax. What is the failure? If profits gets too big, it may end up paying high tax in personal capacity, meaning the owner may end up paying high tax if the profits grow too much. Then, capital. Capital can be carefully spent and managed because remember, the owner is basically one person who will not involve others because this is a sole trader. But when you're looking into the failure, profits may not be large enough to allow what? Expansion, because the source of expanding a sole trader is the profits you make. Now looking into how profit is divided. For the sole trader as a business owned by one person, it becomes very clear. The success is that the owner receives all profits from the business, which will mean they don't have to share with anyone. So that is the advantage over there. So it can lead to capital growth. But then looking into the failure, the owner needs to budget carefully so that the business debts are covered. However, what is the legislation when it comes to establishing a sole trader? It is easy and inexpensive because this means now it is easy to start this business and it needs less amount. So personal debts and business debts are not separated, meaning there is unlimited liability when it comes to a sole trader. So that is the failure there when you're looking into legislation. Then, let's look now into partnership. Management, managers. How is a partnership managed? Partners are actively involved in management and may use ideas of other partners. What is the failure? Decision making can be time consuming because there's many people involved in the process of making a decision. So that is why it is time consuming, as all partners have to be in agreement. Let us look into taxation. The partnership does not pay income tax. The business does not pay income tax. That's what we mean there. So only the partners in their personal capacity. So partners will be paying the tax in their personal capacity, in their names. So looking into the failure, high earning partners pay more tax, which may discourage other partners from joining the partnership because they know that their tax will go up or their tax bracket will be moved to a higher rate, meaning high tax to be paid. Then looking into capital, more than one partner contributing to the capital of a partnership allows for more capital to be in the business. But the failure is that partners may not all have capital to put into the business when needed. Then let's see how profits are divided in a partnership. Partners share profits according to their contribution. So this is to say now they will share profit according to how much they have contributed to the business in a form of capital. That is how they are going to share the profit. But looking into the failure, the amount of work done may not be equal to the amount of profit that each partner receives. So that becomes the failure now for division of profit in terms of a partnership. Legislation, it is easy and inexpensive to start. So one thing you'll realize is that a sole trader and a partnership, those businesses are similar. The difference is that a sole trader is owned by one person, but a partnership is owned by two or more people. So that is why it is easy and inexpensive to start. And looking into the failure with legislation is that partners are jointly and severally liable for the debts of the business, meaning unlimited liability for the partners, which is also applicable to sole trader. Now let us continue by looking into the private company and the personal liability company. Now, private company management. How is a private company managed? This is what you should think about. How is a private company managed? It is managed at least by a one competent, highly skilled director. What is the failure? Director's fee increase the company's expenses, which reduces the net profit of the company. But when we look into the taxation, this has to do with how the company will pay tax. The success is that a company or a private company can obtain tax rebates if they are involved in your corporate social investment projects. A tax rebate would allow the business to reduce the tax. But what is the failure there? The private company is subjected to double taxation. For example, shareholders pay secondary tax, and these can have a negative impact on a company that is already financially struggling. Then, capital. For a private company, how much capital can be obtained? Large amounts of capital can be raised since there is no limit on the number of shareholders, meaning more shareholders can come in and contribute more money to help operate and grow the company. However, the failure is it cannot grow into a very large business since it cannot invite the public. Remember, the process of trying to invite individuals can be time wasting, so it cannot be similar to a public company which can invite the public to come and buy shares. Then looking into division of profit, high profits and good returns to shareholders, meaning when shareholders receive more and more dividends, meaning profits from the company, it indicates the success of a company. So immediately shareholders are receiving more and more returns. That is success. So what does success mean? It increases the value of shares, which increases what? The value of shares. This has to do with saying now, if the value of shares were 20 Rand, for instance, and the company does well, the value of shares can increase to being now 50 Rand. So that's what we mean is the success. The capital amount grows in value. Now, looking into the failure, shareholders may sell their shares when dividends are low, resulting in a drop in the share price. So when the company is doing less profit, shareholders will sell. And when they sell, the share price loses value. So if the share price, meaning if one share was 50 Rand, it can drop in value to be maybe 20 Rand if the company dividends are low. Then, legislation. Limited liability allows for greater risk taking, which may lead to the growth of the business. So the idea of limited liability becomes the success of a company. But when you're looking into the failure, is the idea that the formation procedures are time consuming as many legal documents need to be submitted for a company to start operating. So that becomes a failure there for a private company. But looking into a personal liability company, the management, a personal liability company is managed by a competent board of directors who may be experts in their field, meaning in the field where the company is operating. Then looking into directors' fees, which increase the company's expenses, which will reduce the net profit. You would recognize that this is similar to what we saw or went through in a private company. So I'll just say this is similar to what you saw in PTY Ltd. So that is your private company. Taxation, again, it is similar to what we went through in the private company. The personal liability company can obtain tax rebates if they're involved in corporate social investment projects. And again, another aspect is that the failures that their personal liability is subjected to double taxation. Then another aspect is capital. How much capital can be obtained by a personal liability company? Capital can be increased by getting more shareholders, but what is the failure? It cannot grow into a very large business since it cannot invite the public to come and buy shares. Remember, a personal liability company is similar to a private company. Then division of profit. High profits and good returns to shareholders indicate the success of the company, which will increase the value of shares. This is similar to what we went through with the private company, and again, shareholders may sell their shares when dividends are low, resulting in a drop in the share price. This again is similar to what we went through with the private company. So basically, when you're studying the private company, you are also studying the public or personal liability company. So keep that in mind. So with that being said, let us take a short break and we will continue with the public company.